In my latest post on The Fat Investor, I unpacked Arista Network and Shopify 1H 2026 results. Both are growing at a relentless pace, but a key difference in entry valuation turned one into my number one holding, a 12-bagger, and the other into a valuable position sizing lesson.
So think about it. We have two incredible companies here, both demonstrating just absolutely phenomenal execution, and both putting up staggering numbers for the second quarter. Yet, despite both being high-conviction holds of mine for years, they yielded completely different results in my portfolio. On one side with Arista, we're looking at a massive 12-bagger, literally a stock that grew 1,200%. And on the other side, we have a harsh, albeit ultimately profitable sizing lesson with Shopify. How on earth do two market leaders end up writing two vastly different portfolio narratives for the exact same investor? Let's dig in.
Section 1, Arista's Relentless AI Growth. $3 billion. Arista just delivered its first ever $3 billion quarter. That's a massive 37.7% jump year over year, which pushed their adjusted earnings up by 40%. Now, just to put this milestone into perspective for a second, this single quarter's revenue effectively equals what Arista brought in for the entire year of 2021. Quadrupling your output in just 5 years, that is incredibly rare for a company of this size.
You're probably wondering, what's driving this insane momentum? Well, it's the absolutely insatiable demand for AI infrastructure. These massive cloud providers, the hyperscalers, they aren't just buying for their immediate day-to-day needs anymore. They are actively building out multi-year AI clusters, and this creates a profound structural imbalance between supply and demand. In fact, despite a really swift 12% sales jump over the previous quarter, Arista's backlog didn't even shrink. It actually grew to $6.87 billion. With that kind of unparalleled visibility, management confidently went ahead and raised their full-year guidance to a whopping $12.6 billion.
Section 2, Elite Personnel and Expanding TAM.
Here is the crucial takeaway. You really don't need deep technical expertise in enterprise network switches to win as an investor here. Look, the deep technicalities of AI fabric are way above my head, and I actually have an engineering background. What you do need, though, is the ability to recognize and trust the unbroken, pioneering spirit of this elite C-suite. You've got Jayshree Ullal, who is consistently recognized as a top global tech CEO for pure operational execution. You've got Andy Bechtolsheim, a literal Silicon Valley hardware legend. And you have Ken Duda, the primary architect of their extensible operating system, which fundamentally disrupted the entire legacy networking industry with its zero downtime quality. When you pair this specific dream team with generational industry tailwinds, they don't just ride the wave, they absolutely dominate it.
And an elite management team doesn't just capture a bigger share of an existing market, they actively expand it. They bake a much bigger pie. Arista's total addressable market, or TAM, has nearly doubled from $60 billion to $105 billion. They're expanding super aggressively into enterprise campus networking, routing, and of course AI infrastructure. By collaborating closely with other industry giants, they are essentially forging entirely new markets that didn't even exist a few years ago.
Moving on to Section 3, Shopify's ultimate operating leverage.
12 consecutive quarters. Guys, this number is huge. Shopify grew revenue by 34% year over year to $3.6 billion. That marks their 5th consecutive quarter of 30+% growth for both sales and gross merchandise volume. But honestly, what is most gratifying for a focused investor is seeing that this relentless expansion is no longer fueled by just lighting cash on fire. They have delivered positive free cash flow for 12 consecutive quarters now. This most recent quarter, they hit an all-time Q2 record, generating $654 million in free cash flow at an 18% margin. With guidance pointing to 20% margins next quarter, it proves definitively that ultimate operating leverage, where revenue grows much, much faster than costs, is now permanently embedded in Shopify's DNA. So why is this happening? Picture this. Imagine you're managing a multi-billion-dollar enterprise brand. Years ago, you built your own custom legacy software. But today, just keeping that non-core tech stack alive requires armies of engineers just to handle basic security updates, local payment integrations, and bolting on new AI features. Why waste capital maintaining outdated code when Shopify Plus does it better, faster, and way cheaper? This is exactly why massive global brands like Avon, Canada Goose, Guess, and ELF Beauty are actively migrating off their legacy systems. And historical cohorts show us that once these massive brands migrate, they stay, they scale into new geographies, and they start rolling out offline capabilities. Every single success story here acts as a proof point, creating a virtuous flywheel that just relentlessly attracts the next wave of major retailers.
Section 4, the Commerce Operating System.
Now, just like Arista, Shopify's engine runs poorly on the pioneering spirit of a founder-led culture. CEO Toby Lütke and President Harley Finkelstein don't just sit back and react to commerce trends. They actively dictate them. Case in point is the Universal Commerce Protocol, or UCP. This is an open standard they co-developed with Google, and it is the backbone powering their game-changing new move, the Shopify Agentic Plan.
Let's break down the sheer genius of this setup. Step 1. Even brands that aren't on Shopify can now list their inventory in the Shopify catalog for exactly $0 a month. They don't have to rebuild their legacy websites, they literally just sync their product feeds. Step 2. Once they're listed, those products are automatically broadcasted across AI surfaces. We're talking Google Gemini, ChatGPT, Copilot, for native agentic discovery. And step 3. When a customer says to an AI, "Hey, find me a blue jacket," and clicks buy, the transaction is processed seamlessly via Shop Pay and native checkout. So Shopify is capturing a percentage transaction fee on sales that are happening entirely outside of its core platform. It's brilliant.
And here is exactly why this acts as such a powerful magnet. This native AI catalog converts at twice the rate of AI agents that are just relying on clunky, scraped web data. By letting external merchants experience the sheer effectiveness and accuracy of this tool completely for free, those merchants are naturally going to be pulled into the broader Shopify ecosystem over time. It is a stunningly low-friction acquisition strategy.
Section 5. The critical valuation lesson.
Okay, so bringing this all back, if you had asked me a few years ago which stock I had more confidence in, I would have confidently said Shopify, without hesitation. Why? Plain and simple, a relatable bias. As a retail investor, I could relate to global e-commerce far more easily than I could wrap my head around complex enterprise network switches. Because I liked and understood Shopify's business model so much, I aggressively built an oversized position way too quickly at highly elevated valuations. And that led to a pretty harsh reality check. When Shopify's stock price completely plummeted in 2022 following a massive logistics misstep, my position was already near its maximum limit in my portfolio. I could only justify adding a tiny bit more capital to try and average down. Now, don't get me wrong, the underlying quality of the company prevailed, and it still yields a solid 80% return over 6 years. But contrast that exact scenario with Arista. Now, Arista was never strictly cheap, but its valuation at entry was far more reasonable relative to its massive growth potential. That disciplined, reasonable entry meant I could just sit tight and let compounding do the heavy lifting for me, eventually forging a massive 12-bagger. And today, the cycle repeats itself. With its recent post-earnings pop, Shopify is once again trading very rich at a forward PE of roughly 77x, meaning you're literally paying $77 today for every $1 of expected earnings, while Arista just sits comfortably as my largest holding. Which brings us to the core thesis of this entire explainer, and quite frankly, my primary reminder to myself and to all retail investors managing high-conviction growth stocks. Build positions slowly when valuations are steep. It really is that simple. No matter how much you love the business or how perfectly you understand the consumer flywheel, your entry price will always dictate the mathematics of your long-term compounding. So, I'm going to leave you with this final thought as you evaluate your own holdings today. Take a look at your largest positions right now. Is your portfolio sizing based purely on your excitement about the quality of the business, or is it strictly disciplined by your actual entry valuation? The difference between the two might just be the difference between an 80% gain and a 12-bagger. Think about it.